Good afternoon, everyone. My name is Jesus Nava. I'm the Director of Client Training and Education at TradeStation Securities. Today, we have our guest speaker, Brandon Wendell. He's been with us in many other occasions, and the topic of today's presentation is options replay, strategizing your options trade. So, what Brandon does in these type of situations is that he talks about trades that could have been placed in the past week or two and the reasons why that trade could have worked or not. So it's a great way for us to look at options trades from a practical standpoint. And that's exactly how he presents the information. So we're going to get to him in just a moment. Just as we do in every webinar, we have some disclosures to paraphrase. Keep in mind that every symbol and idea that we talk about is for educational purposes only, that options trading is not suitable for everyone, and past historical performance is no guarantee of future results. So if we look at a trade that worked in history, of course, there's no guarantee that's going to happen exactly the same way going forward. And that's something we need to be aware of. If anybody here needs additional information on these disclosures, go to tradestation.com/important dash information. And one more thing, Brandon Wendell, even though it's a pleasure to have him and a privilege to also share on his expertise, he's not affiliated with TradeStation, so just keep that in mind. His ideas and methodologies are his own. All right, guys, we're going to get started. Now, not sure if Brandon can hear me or he's able to.
Yeah, I'm here.
Okay, perfect. Excellent. Okay, so I'm just going to pass it on to you,
Yep.
Brandon. Thank you for being here. The floor is all yours, okay?
Gracias, muchas gracias. Sorry, I was started talking and started to look at something at the same time and threw myself off there. So I will go ahead and perfect. Okay, I can see the chat as well, and you guys should be able to see my screen. So this is September 29th. Man, this year's going by fast. I don't know, we say that all the time. It always seems to happen that way, but it just seems to be flying by. But anyway, we're doing options replay, strategizing option trades. We're going to talk a little bit about trades that I have completed and still are in process of completing, and showing you some of the steps that are required to be able to place those trades on the TradeStation platform and or the OptionStation Plus platform primarily. Talk about setting up the protective stop losses as well to manage the risk and mitigate problems. And if, of course, if you have questions, please type them in. As Jesus said, I'm not an employee of TradeStation. I was just invited by TradeStation to share my knowledge. I'm a charter market technician and a full-time trader. So basically, my background, there we go. I've been trading since actually 96, 97. And I started off as a retail broker and hated it. So I moved into back office operations. And in those back office operations, I actually learned how to trade. I was dealing with order flow. And that's still the basis of what I do today when it comes to my own personal accounts. I still trade, basically piggybacking off the institutions. I've been an expert on technical analysis on CNBC, Bloomberg, Fox Business, made all the rounds. It's been a while. Maybe I should go back on again. And I don't know, more laid back now, just trading for myself because it's easy. And I also still do mentoring and advising people for, not advising, excuse me, I don't do that. I do mentoring and education for trading and investing. So anyway, that's pretty much my background. You're not hear about me. So we're going to talk about a couple of opportunities I found in the markets. And basically, if you're interested in learning more about what I do when it comes to the markets and how I find things, you can always email education@tradestation.com, and they can get a hold of me as well. I'm on all the socials too. You can always DM me as need be. But anyway, I looked at PNC, which is PNC, I should say PNC, not PNS, Financial Services Corporation. You think I know, I bank with them. Anyway, PNC, I saw an opportunity there that it was likely to be stuck in a sideways channel. And when you're stuck in a sideways channel, that kind of stinks for active traders because it's hard to make profits on a bullish or bearish strategy when the stock's moving sideways. However, as an options trader, there are great opportunities because we can do a third dimension, and that is time, and we can add a fourth dimension, which is volatility. So we're going to talk about how we can sell or buy volatility and time when it comes to our options trades, and of course, how to manage that. Another opportunity I found was Royal Caribbean Cruises, and the stock actually has two possibilities. It was either going to be forming a double top formation and dropping quite dramatically, or more likely, I saw it coming into what we call a demand zone and looking like it was going to bounce from what I have. I have a strategy I created called the 889 strategy, and it looked like it was going to set up pretty well for that. So I placed vertical spreads based on that, and we'll see how it all turned out. So again, if you have any questions, I think, yeah, you should be able to chat. Anyway, we'll jump right into it. So first impression here on September 16th, these are relatively short-term trades because I wanted to be able to just find something and hopefully get through most of the position before we got into class. However, there's still some that are active here. And basically in PNC, you'll see I have just a few things on my chart, not too many indicators. I use a couple moving averages, 8 and 89, and that's because of the strategy I've created based on it. And I use RSI, but I use the RSI as a momentum indicator, not as a typical oscillator. So I'm basically measuring how much momentum there is, and when momentum kind of dies off, then I'm looking for possible changes in trend direction. So with PNC, again, I saw this opportunity where we're pulling back to this area of demand, I call it. It's an imbalance where prices rallied sharply because there weren't any sellers in the area, and the buyers had to be very aggressive and raise their bids in order to be able to find someone to sell to them. If nobody wants to sell, you have to offer more money. That's it, plain and simple, supply and demand. And we were looking like we were going to pull back and possibly bounce off this moving average, which, as you see, can be a very powerful bouncing point for price. So putting all that together, I said, again, it was possible 889 strategy long trade. It wasn't the ideal position because this was actually the first test of the 89 since prices had crossed over. It's my way of playing Elliott wave. Basically, Elliott wave, I don't want to get too much into this, but there are 5 waves in an Elliott wave movement in trend. You have 3 impulses, 2 corrections, and wave 1 is the beginning of the trend. Wave 2 is a correction. Wave 3 is the next impulse in the trend, and then wave 4 is a correction. Wave 5 is the final impulse, and then you get a correction ABC. It's a little subjective, but there's different ways of analyzing markets and seeing those waves. And what I try to do is use this 889 to identify wave number 3, which is traditionally never the shortest wave on its own. It's either tied with 1 or 5 when it comes to the impulse waves, or it's the longest wave on its own. So this was actually right here, wave 1, 2, 3, and we're correcting in 4. So I was trying to catch wave 5 in this case. So we'll see what happens. But basically, the other thing that was likely to happen with this, because we had lost momentum, remember I said the RSI reads like a momentum indicator, and we were bullish back here. We had plenty of bullish momentum, pulled back, couldn't go into bearish territory, still went up, but barely into bullish territory, and now we're flatlining. So we basically have no momentum, and with no momentum, typically you're going to stay sideways until the momentum and trend picks up again. You're also going to be having a loss of volatility. The longer you go sideways, the lower volatility typically moves. Volatility is fear by investors. It's them fearing how much price is likely to move in the near term and also long term. That's what volatility is. If volatility is high, investors are fearful they're going to be very fast, sharp movements in price. If volatility is low, it's just the opposite. They're expecting very small moves or no movement at all. So we can actually do what's called an iron condor. And if you're not familiar with the strategy, there are areas you can go to. As a matter of fact, right here under TradeStation.com, you can go into the Learn section, and under Options Education, you'll see this changing every day. They're adding new parts. And under the strategies, you can go through and you'll find there's condors and butterflies, and also iron condors, iron butterflies. So if you were to select that, you'll see there are videos there, articles, even that you can download for TradeStation, and directions on all that. So what is an iron condor? And then you get more information on the strategy and learn how to use it properly. So here we're actually going to see how it was deployed. Now, this was on the date I enter, which was 9/23. And again, on 9/23, prices were pretty much sideways. So I decided, okay, I'm going to try a couple different strategies and see which one sticks the best or works the best to get the best returns. And that's something that you can do in simulated mode as well, to practice this strategy and see what works the best. So in this case, I was basically selling a bull put spread and a bear call spread. Place both of those together and you have an iron condor. That's all. It's a bull put spread and a bear call spread. You're expecting prices to stay within that range. So as sell calls above where I think prices will be able to go, and I sell puts below where I think it's going to go. Now, so I'm not trading naked with unlimited risk. I buy out of the money options to cover and cap my risk on the ones I sold short. That's all an iron condor is. You're trying to profit from the credit that you're selling on the premiums on those options that you sell, but you have to pay for a little bit of insurance on each side. That's all. So in this case, on that day, this is the screenshot of my trading page. And basically I identified, okay, above the top of the range at 210, I'm going to sell a call. And then I'm going to sell a put below the bottom of the range. And then I did a little bit wider. I did a 15-point spread. So I sold the 200 put and bought the 185, as you can see in blue. And then I sold the 210 call and bought the 225 call. And I did this with only 3 days until expiration. Now, one of the things you have to realize when you sell options, I am selling time. If you take a look, my delta is almost zero. Let's see, do I have, let's see, zoom it. Make sure this is running here. Oops. Nope. Bear with me. I just want to make sure this program's running. I forgot the keystroke I designated for it. Alt-Z, there it is. Okay. All right. That's what I want to do. Basically, with this particular strategy, you can see that I have a delta that is close to zero. Okay. If you are between -10 and +10 on your delta, you are pretty much directionally neutral. I have a little bit of a negative bias, but not much. A 0.006 would be the overall delta, and that times 100 shares, that's $6.33 or 633 negative. So again, I am pretty much delta neutral. It doesn't matter if prices go up or down for me. I'm neutral as long as they don't go beyond a certain point. But here's the main thing that I'm playing. Theta, that's time decay. And what happens is with time decay, it's not linear. It's not the same every single day. If we take a look at, again, see, we look at PNC. I'll go to Option Station Pro right now. Actually, you can look at anything. It doesn't really matter, but PNC, and I go to the options. Right now, if you take a look, we got 3 days left on these options for PNC. The 200 strike right now is delta 64, but has a theta of -27 cents. If I go out 30 days, same option strike, and let's just do this 5. We'll do that. Yeah. So the same strike, 200. Now we have a theta of only 9 cents. So we went from 27 down to 9 cents. So just between the 30 days and now 3 days left, you have 3 times as much time value decaying every single day. If I were to go out further, 108, now I went down to 5 cents. So I cut it in half almost how much time decay there is. Since I'm selling options, I want those options to decay very quickly, and therefore I'm typically going to choose options that expire within 30 days or less. Less the better. However, here's the problem on the other side. The premiums are lower, right? This premium right now is $285 for 3 days, $650 for 30 days roughly, and for a little over 3 months, $1160. So you won't collect as much premium, but you get to keep more of the premium faster when you sell lower expirations or lower days till expiration. That's why zero DTE becomes very popular. So I did 3 days left for expiration, and I ended up with $50 as the natural price. Now, I could have probably held out for more, but I just wanted to keep this simple. The natural price means I'm buying from the ask and selling to the bid, whatever those retail prices are. So you can use market orders. It's not necessarily recommended. It is the fastest way in or out, but you don't get the best price. You're fighting against yourself a little bit. The default on TradeStation is the mid price, which is basically the halfway point between your bid and ask. And you're not going to get that very often. Every once in a while in a very liquid, very quickly moving security, you might. But the best thing to do is usually try to go somewhere in between the natural and mid price to get your orders filled. You have a higher probability and you get a little bit better pricing, and you should use a limit order with that as well. The drawback of the limit order is you might not get filled, of course. So this ended up being a 3.4% return on risk. Okay. And the reason why I say return on risk is because my risk for this position is the difference between the two strikes, whichever one is larger. Okay. In this case, I did even on both sides, 15 points on either side. And even you can see TradeStation points out my max loss is $1,450. My credit that I received is my max profit. So you're at your best on the position as soon as you get in. Things can only go downhill from there. Why? Because you are collecting the maximum profit right away. And as time goes by, you may have to purchase back these options. Remember, you sold them all together is a credit that you receive. So you may have to buy it back at a loss or buy it back for less than what you originally sold it for. So you get to keep some of the profit, but maybe not all. The best case scenario is this expires completely worthless. And because I only had 3 days until expiration, there was a decent probability of that happening. So I annualized this. Is actually 4.2% annualized return. Not too bad, right? What else do we have here? Okay, I looked around for other options. Remember, there's a balance here. And with this option, first of all, we don't have to take the full amount of risk. I do not have to lose $1,450. And in reality, I shouldn't risk $1,450 to make 50 bucks. That seems ridiculous, doesn't it? So we can manage our risk reward ratio by utilizing some special tools that we have in TradeStation. And let's see here, where were we? I want to move this to another screen. There we go. There we are. We have on TradeStation what we call price slices. And those are pretty cool. So what you can do is when you go into the analysis tab, for instance, did I do a picture of that one? I did. Here it is. I didn't put it in my slides, but I did do the analysis tab. So once I chose that particular option, as you can see right here, or not option, that's position, the 185, 200, 210, 225 iron condor. And my break-even points were identified based on if prices go down a certain amount from the strike that I sold. Basically, it's the strike minus the premium. So my downside is 199.50 because I'm only collecting 50 cents. I sold the 200 put. I sold the 210 call. So 210.50 is my break even on the upside. Still a pretty good range that prices can stay in. But then what I need to do is figure out, okay, what kind of risk am I willing to take on this trade? Again, you do not have to lose all $1,450, and you probably should not do that. But what I can do is figure out what is acceptable for me. And it's going to be different for every single person out there. What I do, not all the time, again, it just depends on the type of trade I'm taking. But in this case, when I'm collecting credit, I'm always going to have an inverted reward risk ratio. When I go long on options, it's a little bit easier to control that amount of risk because your maximum loss would be your debit that you pay or the premium paid. When it's a short, in this case, I do have a cap on my risk. Again, $1,450. It was shown right here when I was putting in the order. That's the difference between the strikes times 100 minus the premium collected. So 1,500 because 15 points minus $50 from 50 cents. Okay. So what I do is typically if I'm doing a debit, a long position, I'll try to go for a 3-to-1 reward to risk ratio. The reason and the rationale behind that is you could be wrong 50, 60% of the time and still potentially profit because your losses are smaller than your gains on average. That's not always going to happen, of course, but on average, and of course, not every trade is the same size either. But typically, if you take larger wins than your losses, then you're going to be doing much better. You don't need to win all the time in order to be able to profit in the markets. Okay, I've done this. I've actually had a 40% win ratio in a month, and I was able to be a profitable trader because my wins were larger than my losses. Like I said, when you're doing a credit strategy, that's not going to happen. And it's unfortunate. The reason why, though, we do credit strategies is with debit strategies, you typically need price movement in a certain direction. We have positive deltas. Again, there's exceptions to everything, but when I'm selling an option, I don't necessarily need price to move in my favor. Prices can move in my favor. They can move slightly against me, and they can move nowhere at all. Again, I'm playing time and volatility in this case. So if I do the right type of strategy on the right security at the right time, I have a higher probability of winning versus a debit strategy. That's why I enjoy selling options more than buying them typically. Higher probabilities. So what I did was my rule in this case is whatever premium I'm collecting, I will lose no more than twice what I'm collecting. That means I'm going to set my stop loss at 3 times. So let's make it simple. I'm collecting $50 or 50 cents. So if the prices go 3 times against me, which is $1.50 or $150. Okay, I collected $50 in premium. If it costs me $150 to buy it back, that means I'll have a net loss of $100 or twice what I had collected. So this is at expiration, and you can make adjustments based on how many days are left in the price slices. But notice what I did is I adjusted and I put, again, I plotted on the expiration day to keep it easy, but this will be moving. You will have to monitor this. Let me do an example right now, as a matter of fact. If I go to, let's see, manage, PNC, I still have an iron condor right there. Let's do analyze duplicate. There we are. And this is the position currently. If I were to get into it once again, and this is 200, 215. I'm sorry, take that back. The puts are 190, 200, 215, 225. So they're only 10 points difference. That one's a little different. And what you'll see is there are different lines on my chart for the risk profile. So to calculate, first of all, right now, I would be collecting $165 of premium, basically. So 165 is the credit. I don't know. Nope, it's not showing yet. So if I were to do this, right click and trade, there we go. The natural is actually $1. So let's just do the natural because it's the easy number to deal with right now. $1. What does that mean? I have a 10-point spread. I'm collecting $1, so I have $9 of risk. With $9 of risk, again, times 100 shares, that's $900. How much will I be willing to lose into my strategy? Twice, $200. That means if this spread costs $300 to buy it back, I need to close the spread. What price would that be? Again, at expiration, we're using October 10th in this case, I just move the price slices, not the screen, the price slices until I see negative 300 or thereabouts. There it is, 218.20 and, oops, 306. There we go, almost 300, 196.80. Those are my two areas where I'd want to exit if prices go beyond those levels. Because in theory, again, it's not going to be exact. Why? Because other factors will change. That's just price changing. Time changes, volatility. Let's say volatility goes up. Let's say it goes up by 3%. Now what happens? It's not showing anything here because it's expired. But if I go to a different day, let's say we want to close this out before expiration. Yeah, right now I've got it set with a line at about a quarter of the way to the expiration, one at halfway to expiration from today, and might as well add the extra one here just to show it. 3/4 of the way to expiration. Basically, to get to this page, what I did is I used the little cog wheel right here under settings, and then I go to graph, and I can choose expiration plus 1 day or up to 3 days. That'll be either 2 to 4 lines. Why am I doing that? Because this shows me based on time. Let me put this back to 0 for volatility, first of all. There we go. This tells me based on time and other factors what the theoretical price might be for that particular security. So now let's change this. Let's see, plot number 2 is 8 days till expiration. That means a couple days have passed by. So notice my reward risk ratio is going to be thrown off and my prices will be different. I'm not getting 300 of a loss here. I have to go and adjust the price. That's why I said the stops might be dynamic, not static. You may have to change them slightly. And I can't get it exact either, but that's okay. I get as close as possible. So right now, with 8 days left till expiration, my stop losses will probably be at 197.71 on the downside, 220.34 on the upside. And I might have to change them daily or at least a couple times a week, perhaps, maybe even once a week. Just depends on your position and how much you want to monitor. Obviously, if you can monitor every day, it's going to be much more accurate, right? Now, let's say we go a little further. And before I forget, say volatility rises by 3%. It adjusted, didn't it? That changes as well based on volatility. If volatility drops by, say, 5%, again, it adjusts the numbers. If volatility doesn't change, which is rare, then there I'm at the 300. But I'll have to adjust my numbers based on volatility and on price movement and on time moving. So again, if we go to halfway to the expiration, notice what happens. Halfway to the expiration, my stop losses actually tighten a little bit, don't they? This one is going in to 300. I'm just going to do it approximately. This one actually goes out. So remember, why is it going down a little bit? Notice both of them are moving down in price slightly. It's because I had a negative delta. Slightly negative delta causes that to happen. Now, why do I care about this? Again, let's just keep it simple. Right here, I got this one set. So let's say 5 days left to expiration. That's going to be what? 5 days from now? What's the expiration date on this one? Forgot. I think it was October 10th. 10 days, right? Yeah, October 10th, 10 days till expiration. So we're halfway into the trade and I got to set my stops. How do I do it? I'm glad you asked. First thing I'm going to do is write down these numbers, which I have on the downside. Again, I'll lose roughly 300 minus the 100 I took in, $200 loss. We're looking at about 197.51. On the upside, it is 219.27. This is how you do it. I'll go back to my position, just close this out for the analyze right now. It doesn't need to be there. I'll also clear my trade box because that has to be clean too, I believe. If not, I'm just doing it anyway. There we go. So I go to my position that I have open right now, which again is the PNC Iron Condor 10th of October. And I right click and I go to close this position. Now, theoretically, we're going with the $1. Okay. Don't worry about what it actually is right now. We're saying, okay, I took in $1 premium. I'm willing to lose no more than $200 total, which is twice what I took in. Okay. How do I do this? What I'm going to do is change my order to a market order because in essence, I'm creating a stop market order. Okay. And these can only be filled when the markets are open, obviously, because they're market orders. I can and should also do good till cancel. And this is how I'm going to set it. Activation rule. I click on that little activation rule. This is a market order to exit that position at whatever price the market will give me immediately or as fast as I possibly can. But when do I want it to happen? I click on this little, they call it the ellipse button. Okay, you see it looks like 3 little dots. That's the ellipsis button. So I click on that and it brings up this menu and I say, I want it to happen when PNC, the underlying security, is either greater than or equal to whatever that upside was. That was 219.27. Or, this is very important. You have to put or because prices can't be in two places at the same time. Less than or equal to 197.51. Now, here's another thing you have to decide. First of all, do not forget to put that as or because prices can't be above and below at the same time. It will not trigger. You'll either get an error or it just won't fill, ever. The other thing you have to realize is it doesn't happen as much as it used to, but it still can. TradeStation helps to protect you from dirty tricks that market makers do. Okay, market makers, those are the brokerages who are creating liquidity in the markets. Their job is to help fill orders, match up orders, and be the contra if nobody else wants to trade with you. So if you want to buy something, nobody wants to sell it to you, they might step in and sell. The problem is that they can sometimes delay reporting of orders, and brokers do this too sometimes, either by mistake or with some malintentions. They might actually have a trade that they do, but instead of reporting it to the exchange, I don't know what the reporting requirement is anymore. It used to be 90 seconds. Within 90 seconds of a trade occurring, it was supposed to be reported to the NASDAQ. I think it was 180 to the NYSE. That was years ago. It's probably changed. But here's the problem. It doesn't matter because it's a very small penalty if they fail to do it. So why would somebody not want to throw in a trade right away and get it recorded right away? The trade will happen, but they may not record it right away and report it to the exchange. The reason why is, let's say prices, they were buying at $100. Okay, so they bought at 100 and prices started going up, but now it's just stagnant. It's not going anywhere. If they throw in their late trade, or I'm sorry, throw in the reporting of their trade late, it's called a late print. What'll happen is all of a sudden prices are now at 105, 106. And here comes this trade at $100. And the market sees that. If you have this set a single trade tick, when that gets reported as a trade at $100, anybody who has a stop at $100 or less, or I'm sorry, let's say $105 or less, $100 is less, it's going to trigger people's stops, even though the prices are not really at that level. It was a late print. It's a dirty trick, isn't it? But it's perfectly, well, it's illegal for them to do it. But again, it happens. It's also like speeding, because I'm sure everybody in this room never drives above the speed limit, right? Why? Because it's illegal. What happens if you're caught? You get a ticket. Stinks, You pay the ticket, do your driving school if you need to. I've never had it, so I knock on wood, never had one, so I don't know. But you would have to have the driving school, and then you might have a higher insurance rate, all that stuff. Is that enough to keep you from speeding again? Maybe not. It might be a little bit where you start slowing down a little bit more, maybe you slow down that area, but you don't necessarily stop speeding. The same thing happens if these brokerages are caught throwing in their late trade ticks. They may not stop doing it because the fine is not big enough for them to worry about it. So to protect yourself, you can do this. You can say, listen, I need to make sure that's a legitimate trade, and it has to be at least 2 times it occurs and has to happen inside the national best bid and offer. Now, that'll slow things down a little bit, obviously, but you need to actually have prices trading in that area rather than having a late print coming in. That's the whole reason why I went in that diatribe there. TradeStation gives you these extra protections, so you can do whatever kind you want. A lot of times I just do the single trade tick because it hasn't really occurred too often, but it still does happen that you get the late prints. So to protect yourself, you can say, I want 2 trades to occur at that price level or beyond, and it has to happen inside of the national best bid or offer. So there you go. You can put that in, double trade tick or double trade tick is usually what I do, NBBO. And then I hit OK, hit analyze, I'm sorry, not analyze, place order. And it's after hours now, so it's not going to place the order until tomorrow, but it is good till cancel. I will get out of that position at the expected price, a market order, if it goes beyond the certain levels. And again, in theory, it'll be roughly the $200 loss I'm expecting. It won't be exact, as I said, but it's roughly that. And I got my order rejected for whatever reason. I'm not going to worry about now, but that's how you would normally do it. Rolling for a credit, yeah, you can definitely roll. Let's see. You can roll positions. For you're talking about if your prices are moving a certain direction, you can basically roll for more time and create more premium for yourself. And yes, you can also take a profit rather than 100% of the profit, take profits early at 50% if you choose to. Absolutely, you can. So let's see. Rolling for a credit under following conditions, 68% in the money, extrinsic value, less than a quarter. I should have more than extrinsic value. It depends on what you're trading, how much time you're trading. I guess with 3 days, yeah, I might not have that much extrinsic or time value. But yeah, you can roll your position if prices go in the money, or sorry, your options go in the money. However, if again, go back to manage and go to this position, analyze duplicate. Yeah, basically I have a stop loss that I usually set, and then I'll just do a new position if necessary. Because typically if I get stopped out, it's because the conditions of the markets have changed, and therefore I probably don't want to be in the same position. So I won't roll as much as I would create a new position. Okay. And by the way, you can always close one side and not the other, because if one side's losing, the other side obviously is not. Now it could roll back and go the other way. That's the reason why sometimes I will close both and stop the entire position, because the profit that I'm receiving here offsets the losses I'm receiving on the other side. And that's how you actually only have that 2-to-1 loss. If I only close out the leg that was getting threatened, then I would actually have to adjust my stops tighter to adjust, because I'm not collecting the extra premium. Does that make sense? So I'm not taking both sides. So it makes an adjustment. You can definitely do that. It's a personal preference. If I'm wrong, I get out, period. In this case, I was actually right, so it didn't matter. Let's see, what was the other thing? I think I answered the question. Yeah, roll before short assignment on the downside for the iron condors. So either side, honestly, right? You've sold 2 options. So before you get assigned, if it goes beyond your strikes, yeah, you can roll the position if you want to by buying it back. You're going to be buying it back at a loss. But if you go further out in time, because of that extrinsic value, you might actually recoup a credit and be able to do close the position, roll it for a credit. Yes, absolutely. A lot of people also will not hold these into expiration. As the time goes by, you can see what's happening with these lines. They get higher and higher. Sometimes if prices haven't moved a whole lot, prices will go up. Or not prices, excuse me. The value of the option will decay from time. And if you can get 50% of your credit, so in this case, instead of $1, you get 50 cents, 50 cents, then you just close it out early. For the 3 days, there really wasn't reason to get out. I only had 3 days until expiration. So I just held for 3 days and got the 3.4% return on risk. So in reality, I've actually adjusted my return on risk, didn't I? because in theory, I'm actually only risking $200 rather than risking, in this case, I was collecting what, 50 cents. So I'm really only risking $1 to make 50 cents by putting in the stop. Now, again, it could be a slightly higher on either side, but that's a much better rate of return, isn't it? 50% return on risk and a much better annualized return as well. The other one I did, there's actually two more that I did at the same time. Two of them expired. Actually, this one I did not put on. I just analyzed it. And this was a 10 wide. And the reason why I analyzed, I just wanted to see time and price, how much of a difference it made. And the interesting thing in this was I did a 10 wide spread, 190, 200, 215, 225 for 80 cents or $80 on the natural. And that was a little bit higher return on risk because I was risking $920 to make $80. So 5.6% versus 3.4%, but the annualized dropped quite a bit. I went from annualized 4.2%. Remember, this is now 10 days till expiration, and that was only 2% annualized. So take a look at what you're doing and try to get the best returns. That's why it's good to experiment with different iron condors. And of course, you can always put in those stop losses to help prevent that $920 loss, or not prevent, to help lower the probability of you having to take the large loss. Remember, if the market closes and your stock gaps beyond, nothing you can do. That's why I trade options on futures as well. With those, you can definitely take advantage. And we have education on that as well, by the way. And then the one that's open currently that you just saw, this was also a 10-point spread, 190, 200 for the puts, 215, 225 for the calls, 10-point wide, 17 days till expiration. Now it's only 10. And I collected a 13.2% rate of return on risk and a little bit better annualized return as well. Yeah, this was a 10-point spread. The previous one was also 10-point, but notice I increased my annualized return and also almost doubled my return on risk. I now collected $1.75 or $175 with $825 of risk. Once again, I could reduce that risk by doing the price slices to figure out where would I be needing to buy back at 3 times what I was collecting. Let's see, do I have my calculator open still? No. Calculator. And this is, let's see, I did $1.75 times 3 is $5.25. So $525 is a better loss than $825. So going back to the position, because it is still open, and if we were to go to, not today, because obviously today is closed, is done, but we can do tomorrow. Right here in the blue line, I'll just go forward 1 day. It's going 9 days till expiration. There we go. I was watching right there until within 9. So September 30th, tomorrow, when this market opens, actually, wait a minute, let's clean it up. Let's see where I need to put my stops right now. Okay. So if I'm willing to risk 525, I just need to adjust and see where should the stops be. Because again, my maximum risk is on that blue line now, not the yellow, because that's an expiration. And you can see it can go, well, obviously I can't risk more than the, was it 825? Oh, hold on. I need to change this. Did I collect 165? I guess I did. It wasn't 175. No, it was 175 for the trade. So I need to adjust that as well. There we go. So 175. And if I'm adjusting now for the actual stop that I should be having, come on, there we go. I just move this until it's 525 or thereabouts. There's 527, 525. There we are. So 224.13 on the downside. Oh, nope, wrong way. That's close enough. So I have 195.29, 195.29, and 224.13. My pen went out there. Let me see for a second. Again, I can go back. Let me just make sure under managed, I don't have any pending trades. That's just today. I'd have to go actually, one, open orders. This is on PNC. Nope, I need RCL. And do I have any open orders right now? No, these are all filled. So I should be able to place an order because I don't think I have any filled or pending orders right now. Nope. I just want to make sure. So again, I go to PNC, analyze duplicate. Or sorry, not duplicate. I should have analyzed close. That's the wrong one because that's what I'm actually doing is trying to close. Delete. Take that one off. Go back to manage again. Analyze close. There we go. And it shows the opposite, the upside down, but I already did the analysis. So I know the prices I need to get out. I could actually just go here and do trade. because I'm not going to analyze the upside down version. It's just closing out the position. You can see close. Again, I'll just do market order, good till cancel, and activation rule. Do this. Oh, I did PNC, didn't I? Instead of the, oh, it is PNC. That's right. Sorry, I have another one I was looking at as well. PNC greater than or equal to 219. I'm sorry, no, 224.13. I was looking at the wrong one. Should not use the same tab to write the numbers down. And 195, it was 29. Again, make sure it's or. I'll just do single trade tick for now. That's fine. Hit OK. Place order. And my order was rejected for some reason. I'll have to figure out why, but it should have gone through. Does OptionStation Pro allow for OCO orders? I'm not a TradeStation employee, so you'd have to talk to somebody more involved with TradeStation that would actually be able to answer that. Because if you place an order with the one I just did, for instance, with the conditions, I can't do 50% max profit unless I calculate the actual prices. Or I'd have to do on a single option, you could do it by placing in the price of a single option getting a certain level. So I'm not sure. Yeah, I don't know if they do the OCO orders on OptionStation Pro or just on TradeStation itself. Okay, so getting back to where I was, I already mentioned this. I had slides on it as well, but establishing activation rules, you can establish the stop losses. As I said, you basically create a closing order. So you click on whatever position you want, either do the analysis on the duplicate first to figure out what prices you want, okay, because you can't do it on the premium, unfortunately. Sometimes you can actually just place the stop loss based on the premium hitting a certain level. Here, you just do the price slices to figure out what price is likely to be there when you hit or when the premium hits a certain level. So again, I was looking to see when prices got to a $525 value that I would have to buy it back and I would lose twice what I was going to be collecting. I figured out what that underlying price would be and use the price slices for that. So I changed it to a market order, activation rule, click on the ellipsis, and then put in the prices with the or caveat. So you can do that. You could actually figure out for your profits too, whether you can't do time other than the same day, unfortunately, for the orders. With the activation rule, you'll see it shows time, and you can figure out based on days when it should expire, and you profit a certain amount, but you can't do that. It's only for the same day. But if you have a directional trade, you can again use the price slice. Say we have a bull spread, you can figure out at what price would you profit roughly 50%. And yes, you could put in your exit. Let's do that. I'll show you on the next one. So this is the OCO question that you were just asking. So results, obviously the 2 expired, the 7-day and the 3-day expired. And as you saw right now, the other, oh, that was it. Cancel. Where's my positions? Manage. PNC, that one's still up $10. And I still have 10 days left till expiration. But again, I'm looking for keeping the premium as long as prices stay within that range. And as of right now, they're staying in the range. I also looked at Royal Caribbean. I mentioned I was going to look at that as well. And this is where I can answer the question, Chris, and see what we can do in sim or in live. May not be able to place 2 orders, but I might be able to do the conditional orders on the activation rule to do both target and stop. But we just have to figure out the underlying price at which it should trigger. So in this case, I figured prices were coming down to an area of demand right here. There was an imbalance and I was looking for a bounce. I'm a little concerned about the fact that we have a double top formation here where we got that second peak, but we have a negative divergence on the indicator, which suggests that we are either going to go a little sideways or possibly down. So I was expecting a possible bounce off that 89 moving average because it would be the first touch since we've had the crossover. And we're above 40 on the RSI, which is a bullish sign. So again, I was planning for a possible bounce. And I also put in some projections as to where the targets might be, because that way I can figure out, instead of just buying a call, which might cost a lot of money, I could actually reduce my risk and cap it by doing a bull call spread. Or depending on how volatility is, I might actually want to do a bull put spread. If volatility is high, expected to come down. So I also looked at volatility, and what I saw was that volatility was definitely high compared to the average. And yeah, the last time it was up around this area, we have been coming down. So I was expecting volatility to come down from this area. It wasn't extremely high. It was still in its 40% range compared to historic volatility, but compared to itself, implied volatility was above its average. And the bands are also a measure of volatility, if you will, but they're not as close as actually looking at implied volatility. So we had average to high volatility expected to come together. And possible either prices moving sideways or bouncing. So a slight bullish position was what I was looking at. I did a bull call spread, and it's the 310, 350 bull call spread. Now, this is a debit spread. You'll notice $17.70 is the cost. It's cheaper than simply buying a call, and I don't need that much time, 63 days. I'm not going to hold 63 days for a long position. The reason why I buy more time, again, is that time decay. I do not want to be in when there's less than 30 days left till expiration because a time decay erodes the value too quickly. So I buy a call, I buy a higher strike call above where I think prices are likely to go before I get out of this position. And now I have a positive delta. That's the difference between the iron condor and this. I have a positive delta, 27.2. It would have been higher if I simply bought a call, but I also would have had a higher time decay penalty by just buying. Selling an option with the long reduces that. It also reduces my exposure to volatility. Because if this is a debit strategy, I don't want volatility to go down. I want it to rise. And I have a decent 2-to-1, not quite 2-to-1 reward risk ratio, but I have more reward than I have risk. Remember, I don't have to risk 100% of that 1770. I can set that stop based on prices. And this is just showing the analysis that I was doing with the price slices. I don't think I set the slices at anything in particular. I was just looking at the price right there. Oh, no, it was at the strikes. That's all. Another opportunity was to do a bull put spread. And actually, the first one I did a mistake because I did 63 days till expiration. I did the same series. And the reason why I kept it, because I want to compare the two between the 63 days till expiration, selling puts below current price, and doing 28 days till expiration, trying to capture higher time decay. I also got a little bit better pricing at 320, 310 versus 310, 300. And the Jade Lizard I'll save for another time because I'm running out of time here. But looking at that trade or those trades, Royal Caribbean right now, there we are. Basically, one of the puts, what is this? The further time till expiration, as you can see, that's not positive right now. It's a negative position. Meanwhile, with less time till expiration, I'm actually profitable. I'm profitable for two reasons. One, I sold less time, November 21st versus October 25th. So time decay is working better in my favor. Does it show my theta? 112 versus 173. Unfortunately, not right next to each other. I don't know if I can move them. No, well, let me move them around. But you can see that I have more time decay, so that's helping me. My Vega volatility is also not as sensitive by using less time. The more time you have until expiration, the more risk you have with volatility, the greater Vega you will have. And I also have slightly greater delta as well, because I'm closer to at the money when I sold those options too. So that's why this is in a much better position right now than what's happening here. And even though I had more time left until expiration, I didn't even collect as much premium. So my rate of return is much, much better. As far as volatility and what's going on with the security, oops, I went too far. Here we are, RCL. You can see the entry date, I forgot what it was now. It was, the 23rd. This is relatively new. No, that's not it. Looking at the wrong one. That is PNC. RCL is 919 for the entry. So we're still relatively close because I was waiting for certain things to happen in price. But there we are, 919. And you can see the volatility has come down just a little bit, which is why the short position is a little bit better. There, a bull put spread versus the bull call spread. And looking back at the long position for the bull calls, that's actually doing pretty well, 165. And that's because of the delta price movement. There we go. Looking at the three different positions side by side right there. I had to pay $1,775 for the opening of that position. It's profitable right now by almost 10%. Not too bad. And I'll obviously keep a lot of that premium because I can go ahead and close this out when there's 30 days left till expiration, as long as prices move in my favor. So showing the current underlying price, 326. So obviously this is getting profit from the delta right now. That is in the money, $16. And that's why I have that price movement, but I do have negative time decay and I'm not really getting much on the volatility. So really all of this is from price action moving in my favor. So I'm not going to do it right this moment because I'm running out of time, but I could figure out profit wise, which one is giving me the best rate of return. Now, if I want to get out of this position, let's say 50% potential profit. Okay. My potential profit for this position, I bought in at 1775, right? And I have a 40-point spread. So again, 40 minus 17.75. That's 22 and a half. Sorry, 22 and a quarter potential profit. Because if it goes all the way to the short strike, that's how much I would make, 22.25. Because you got to subtract what you paid to get in. So half of that is what I'm attempting to profit, right? Or 11.12. We'll call $11.13. That's my potential profit that I'm looking for. So what I could do is, again, go back to the price slices by analyzing this position, analyze duplicate. I think it's got too many on here. That's the long. Make sure I take off the others. Why is that not looking right? Oh, because there's another one underneath it still. That's why. There we go. So now it's analyzing. There it is, the bull call spread. And what I could do is simply figure out, based on time passing, again, let's say I'm willing to exit this when there is about 30 days left till expiration, roughly. That's what I'm looking for. And I'm just adjusting this graph and using the numbers right there. So I see 30 days till expiration. There we go. And now, again, I'm looking to profit $11.25 or $1,125 total. Roughly 340.65 is where I want to exit. So again, I can write that down, 340.65. Now let's say I want to maintain roughly a 3-to-1 reward to risk. That's only a 50% profit for what I could potentially get, again, when it keeps going. And what I would do then is, on the other slice, pull this back until I'm negative 1/3 of that. And I can set my stop based on that right now. So let's see, 1125 divided by 3, 370. So if we take a loss of roughly 370, that's pretty close. There it is, 325.70. That's it. Now all I have to do is close this one, go back to my manage, the position I'm looking at, there it is, the bull call spread, right click, close this position. And again, this is going to be dynamic. It's not going to be static. I'm going to have to adjust this, obviously, as time and volatility changes. But as of right now, I go good till cancel, market order. They're all close. Activation rule if the price of RCL gets greater than or equal to, that'll be my profit, 340.65. If it goes less than or equal to 325.70, single trade tick. That should exit the position. If prices go above, again, it will sell to close the vertical spread, bull call spread, with a market order. It may not be exactly what I want, but theoretically it should be about that level. And it'll happen if we go above or equal to 340.65 or less than 325.70. Hit yes.
Order reject.
And again, it did my rejection. I think I have to place this during regular trading hours for it to work on the sim, unfortunately. But that's how you can do it. So that's how you can do an OCO by just putting separate prices on the market order for the activation rule. So that's what I've got for you guys for today. I want to thank everybody for being here. Again, if you have more questions on things that we went over, by all means, email education@tradestation.com. And if you want more education on the activation rules, actually, there's that in the TradeStation's website. Again, under that Options Education Center, there's a section on the activation rules as well. So thank you for having me. Again, appreciate it, Jesus. I'll turn it back over to you.
Thank you, Brandon. Always a pleasure to have you. And thank you for sharing your expertise with us as well. Those are great examples. Everyone, thank you for attending this class. Check out our events calendar. We always have great topics coming up. Remember that Options Replay is a recurring presentation. I believe the next one is 2 weeks from today, but I would double check with the calendar just to make sure that the dates are correct. But Brandon is with us every 2 weeks for Options Replay. Thank you, Brandon, for your time. Everyone, have a wonderful afternoon, and I hope to see you in one of our future classes. Goodbye, everyone. Great having you.